Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. With us around the table, Citi's Rob Sockin, Michael Cloherty of UBS. Michael, to you first, your reaction to these numbers this morning?
Yeah, not much of a significant change. So, there has been a little bit of slowdown in growth from the really hot numbers last year. Still solid, composition still pretty good right now. But do think that we're going to continue to get some slowing as we go forward. I think one of the issues for the rates folks out there is everyone's been mesmerized by this rise in the equity market, thinking that strong equities means strong economy, therefore high rates. The problem with that is, earnings were solid, but an awful lot of this rally has been AI and other non-economic, non-cyclical factors. So I think that, as we go forward a little bit, we will see some slowing. We've taken out most of the downside risk in rates. After a long time, we're expecting lots of easing, decent recession probability. We priced most of that out, and so I think the market's cheap right here.
Rob, you're looking for some slowing, some big-time slowing, because you've got a rate cut call for July. I'm trying to work out what the data needs to look like from here going into July for that to take place. And let's start with payrolls next Friday. How bad does that Friday number need to be to keep your rate cut call in play?
Yeah, absolutely. And to really get there, as you said, you need some type of nonlinear slowing in the labor market. And right now, these jobless claim figures, which are some of the best indicators of the labor market, are not really pointing to that. They're still quite low, quite stable, point to a fairly robust labor market. Right now, our U.S. team is looking for just a shade below 150 on payrolls. You'd probably have to see an even larger slowing in other labor market indicators and in the labor market more broadly after that to really get that July cut on the table. So I think if their call is right on payrolls, you're still not quite in that danger zone yet where the Fed would really be worried about that nonlinear slowing, but it would be a pretty notable slowdown from where we've been. That said, there's a lot of uncertainty around the report. For example, bad weather in April likely depressed April payrolls. It's possible you get some payback in May. So there is some upside risk to that figure.
It doesn't sound like, Robert, you have as much conviction about the July rate cut as maybe a month ago. Is that true? I mean, are you basically thinking how far before we have to backpedal on this one?
It's a tough call, as you said, and you're seeing that obviously reflected in markets. I think to get to that July cut, you would need probably some combination of soft enough labor market data and enough decline in the run rate for inflation that the Fed is seeing progress on the inflation side of its mandate and gets worried about activity. So the bar for that to happen, both of those things is pretty high. We're still holding on to, as I said, we see a lot of softness in a lot of more minor labor market indicators like surveys of small businesses, hiring within the PMI reports. But even still, as you said, the bar is pretty high to get there. And I think over the last month, it's become a bit more challenged.
Michael, from that standpoint, this is something people have been grappling with, and suddenly Bill Dudley is talking about the fact that maybe if you hold rates higher for longer, it isn't going to be restrictive in any way, shape, or form. And in fact, we should be talking about holding rates here indefinitely. In Robert's view of things, and I believe you're sympathetic with this, it's actually not the case, and that if the Fed doesn't lower rates soon, it could actually tip the economy over into a hard landing. How much more are you thinking about that type of scenario at a time where the data isn't cooperating with the Fed cuts as quickly?
Right, I think that's more an issue for later in the year, but it does seem to be restrictive right now. We're certainly seeing it in housing numbers starting to soften a little more right there. So some of these most interest rate sensitive sectors of the economy, you are seeing a bite. So it does have some effect. It's been a little bit offset by the fact that credit spreads are extraordinarily tight, and you're getting these other loosening of financial conditions offsetting it. But generally, I think it is biting. If you stay here, eventually you'll feel a squeeze.
Mike McKee, we wanted to come back to you for a final word on this. We're all looking ahead to John Williams of the New York Fed a little bit later on this afternoon. This piece that Lisa just mentioned from Bill Dudley, getting everyone's attention. The Fed thinks it's fighting inflation. Think again. Even at more than 5.25%, the central bank's short-term interest rate target might not be high enough to cool the economy. Mike, first of all, what's your reaction to that? And what would you look for from Mr. R-Star himself a little bit later this afternoon?
Well, it's something that a number of Fed officials have been talking about, including John Williams, who spoke to me about a month ago here on Bloomberg television and said that he was beginning to think that R-star, the neutral rate, is higher than the Fed basic consensus is of about 0.6%. And if that's the case, it would have implications for how much the Fed funds rate is holding back the economy. And it raises that question that you've heard a number of people talk about, of whether they might have to raise rates. The other option is that we still see lags at work, and we're going to be seeing them hit the economy and bring growth down and bring inflation down at the same time. So the interesting thing, I think, from Williams would be if he speaks about that, because we sort of know what he thinks. It's going to be like everyone else, that it will take higher for longer to get inflation down, and we're committed to that. But what does he say beyond that that might make news? That could be it.
Well, Rob, and I know that neither of the people who are around the table, Michael, Robert, both of you are not sympathetic with that view. You believe that there is a restrictiveness and that we are seeing that come through. Rob, what would you have to see to actually go around the Bill Dudley school of thought?
Well, as you know, we are seeing interest rates bite different parts of the economy at varying speeds. We're seeing ongoing tightening in credit conditions, weakening credit demand, stresses in lower income consumers. But that being said, if you look at the data, growth continues overall to hold up quite well, even at rates at a fairly high level, a rate that I would think is fairly restrictive. So I would say if we're going into the second half of this year, and it was mentioned earlier, the Atlanta Fed nowcast is running a pretty strong growth of second quarter. If we keep running at numbers that look like that, it would lead me to believe that either rates would have to stay at these levels for a much stronger, longer period, because maybe short-term R-star has risen more significantly than expected, or maybe even rates could have to go higher from here. So I basically would have to look at the data. If we don't get that type of moderation or cooling in activity, I think I would move more into that camp.
If you move into that camp, what does that do to your July call? Is that just totally the back end of the year, or you push it to 2025?
I think depending on how well the economy continues to hold up, we would have to probably push out that call even further. That may raise the risk of some type of harder landing ahead if the economy has to face very elevated rates for an extended period. Normally, we don't have to face rates at these levels for such an extended period. So basically, I would think it would get pushed out towards later this year. And depending on the resilience, it could get pushed out even further.
Michael, do you agree with that? That it's just a matter of just if you do see this kind of ongoing strength in the economy, you might have to reset and kind of come around to this idea that maybe rates are not that restrictive at all?
So even if R-star is 50 basis points higher, we're still much tighter than that currently. So, you're still tight anyway you come up with that. In addition, for some of this, high Fed funds rates forever, I think one of the challenges to that is R-star is really just shorthand for broad financial conditions. It says, at a different funds rate over time, everything will average out a certain way. If the consensus is right and we're going to see steepening in the yield curve due to all this supply, if you have a 2.5 funds rate with no term premium, that's very different financial conditions than 2.5 funds rate with 100 basis point term premium. In that case, the Fed needs to have funds rate lower rather than higher to offset that higher rates out the curve. So I think the hurdle to get rate hikes from here very, very high. Does feel like inflation is going to slow too.
Are you and the team saying buy bonds? Is that the call here?
Yeah, I think at this level.
Where on the curve?
So I think we're more sort of out in the 10-year sector. I think that at these levels you've got real yields at 2.25, so value there.
Well, just to sort of build on this, in other words, you believe that one way or another, inflation is going to come down, the Fed's going to cut rates. What about the other component, the idea of what we've been talking about, the term premium, and all of these questions around just the fiscal profile of the country?
Yeah, over long-term, supply has a huge effect. Every time my teenage daughters give me a hard time, I just roll with it because they should be angry. All this debt they're going to inherit from us. So
you're a better human than I. Carry on.
The problem is in the short term, the swings in demand are so much larger than the swings in supply. If you look back, the biggest supply shock in history was U.S. ran a budget surplus from 98 to 01. For the first 2.5 years of that, the term premium went the wrong way. So it's really the demand shifts overwhelm the supply shifts. So if you do these supply trades, they'll probably work eventually, but it's going to be an awfully bumpy ride on the way. Very few people will be able to hold that trade to maturity.
UBS's Paul Donovan overnight after the auctions said trussing up treasuries. Obviously immediately thought of Lisa. Are you saying this is basically something that it's not immediate, in the back burner? This is a problem that the market should care about?
It's the issue is we just don't know where the breaking point is. And the trouble is it feels like Congress, because they haven't, they've been hearing about this tree branch breaking for a long time, and so they're sprinting as fast as they can out the tree branch right now. We don't know. We're in new territory here. But I think it's really one of those things where the supply, you don't trade based off of that, you size your trades based off of that. So if the supply works for your idea, you upsize your risk a little bit. If it works against your trade, you downsize it a little bit. So it's really more of a tail risk right now.
Turns the volume up and down just a little bit. It's an interesting way of thinking about it. When I hear about doom, read about doom, I think of Bramo too.
Aww.
First thing, just Lisa. Liz
so
Truss,
kind.
Bramo.
It was
First
for
place
her.
I go. First place I go. We're all thinking about the supposed inflationary outcomes of November, whether it's going to be tariffs, what it might mean, additional supply, fiscal easing coming from whichever administration we might get. Is it still too early to think about those themes from your perspective? Because we're getting guests coming on already at the end of May thinking about them.
No, I think those are real, and I think they're, whichever party wins, you're going to see tightening on that side. It's a scale difference, but same direction on those things. That said, the reason we're kind of optimistic about inflation in the near term is if you look at, all of these rental surveys, those peaked and rolled over a while ago. And so we all thought that meant that OER, the biggest piece of inflation, was going to roll over too. The problem is that those surveys had run well ahead of OER for a long time, and it turned out OER had to fill the gap between those. At this stage, it's filled the gap for all the surveys except one. So it does feel like we're finally going to start to see, some of this OER start to slow. We can't be 100% sure because there still is one survey that there's some gap to fill, but the preponderance of data says it'll slow.
Rob, to John's point, how are you thinking about 2025?
Well, I think for the election and looking at the domestic implications, I know there's a lot of debate about this, but we still think deficits are going to stay pretty large no matter who comes to power. The CBO is projecting 5.5% or something around those levels for deficits per year as a percent of GDP over the next decade. I would probably look at that as sort of a floor estimate of where things could go. I think it's interesting when Trump and the Republicans were in power, they cut taxes and boosted deficits, and when Democrats and Biden were in power, they boosted spending and boosted deficits. So I think until the market really tells them this is a huge problem, and it would have to be a lot of market pressure, I think we're going to get large deficits for the foreseeable future. And then thinking about some of these international components, as you mentioned, I think both parties are going to be very tough on China. I think we saw that recently with the Biden administration's new tariffs on China. And in terms of tariff policy, Trump is probably going to be even more aggressive than Biden. I don't think he would go as far as 60% tariff on China, but I think his 10% across the board is something we have to take seriously. But the Biden administration is not going to shy away from using them, and at a minimum keeping what's there now in place. So I think tariff policy is going to be used or in place pretty extensively, and I think deficit spending is here to stay until markets tell them otherwise.
Hey Rob, it's good to see you. Thank you, sir. Rob Sockin there of Citi alongside Michael Cloherty of UBS. In some of the games of stocks we've seen this year, this one right here, I don't think it's been talked about nearly enough. a year-to-date move of 134%. Announcing a partnership with NVIDIA won't hurt to expand its AI services. Let's have this conversation with Bank of America's Wamsi Mohan, lifting his price target on Dow to 180 and writing this: we expect strong momentum into 25 given upside from AI servers, high-end storage and PC refresh with optionality from AI. Wamsi, good morning to you.
Good morning, John.
What is behind that monster move in Dell? And have you ever been busier?
It's incredible. I would kind of pose this as almost a hardware renaissance, right? Like we've not been in a period where these hardware value stocks typically have performed as growth stocks. And it's been a real change in perception, in re-rating of valuations. And this is happening all because AI at its core is really going to be driven ultimately on physical servers. And physical servers, as we well know from NVIDIA's perspective, are in big demand. And who are the suppliers? Who are the arms dealers for that, right? So you look at the hyperscaler market, you got the Taiwanese ODMs. But as you think about AI adoption more broadly at tier 2 cloud service providers or in the enterprise, that is where Dell really shines. And so Dell's really been able to come up with a great story putting this technology together. And if you remember at GTC, he was the one Michael Dell was one of the executives who was called out multiple times by Jensen. And I think that added a lot of street cred sort of to Dell's AI initiatives and the capability of those servers.
You've listed a bunch of reasons to be constructive: AI servers, high-end storage, PC refresh. Where does PC refresh rank for you? I'm trying to work out, are we about to see this big upgrade cycle? Everyone just saying the desktop's interesting again, let's upgrade the PC.
Yeah, John, look, I think PCs are probably just in the order that you described, right? The third order of sort of like the key drivers, because servers as a magnitude of the opportunity is just much larger dollar-wise. When you think about storage, they are tied to the high-end storage, and IBM's coming up with a mainframe refresh next year, and Dell is very well positioned. And these are the high-margin, 60% plus gross margin opportunity that Dell has. When you think about PCs, the refresh is not so much about AI PCs per se, in our opinion. I think that'll take a little bit longer. But we do see the echo of the boom of the demand that came up during COVID. So you had about 150 million extra PCs sold in the COVID couple of years. And off that, we'd say a third of that were Chromebooks, and maybe about 40% of the remainder were commercial PCs. Those commercial PCs are coming up for a refresh, and that's material. So when you think about that coupled with the commercial refresh that's going to be driven by Windows 10 end of life, those are two big catalysts that can drive PC units much higher than sort of the flattish that we've seen up year to date.
I wish I could go back a couple of years and all the people who are saying the personal computer is dead and really sort of highlight some of these earnings. It's not just Dell. HP came out yesterday after the bell, also beating expectations and said about 10% of shipments in the second half of this year are going to be AI equipped. How do you understand who the winners are going to be in this renaissance of the PC and who the losers are? I'm thinking maybe Apple, who haven't maybe adapted as quickly.
Yeah, I would say that our view on AI at the edge, more broadly speaking, Lisa, is that when you think about the devices that hold most of the content and the information that consumers want to use and on a daily basis, it's really going to be the smartphone. And we're talking about the smartphone actually becoming dumb, more like a feature phone. And the next wave of phones that are coming, which we're calling the IntelliPhones, are really where the intelligence is embedded. You got AI agents at the back that are pushing information back to your apps or forward-facing phone users. And so we think that that adoption cycle is going to overtake the AI adoption at PCs. On the winners and losers on the PC side, right? PC market's consolidated around the large OEMs of Dell, HP, Lenovo, and so on. I think that remains pretty much status quo. On the Apple front, we think that AI is going to be all across all devices, right? So this is something that Apple's going to do from the back end. They will do partnerships as opposed to just kind of driving more capability at the edge. And these partnerships are going to be server-based. So this is part of the reason why we think that the AI PC story itself is marginal in the near term, because there are not a lot of apps that require that heavy compute power right on the device. And Apple's got, its M4 chip, and when you think about the way that most people are classifying this AI capability at about 40 tops performance, Apple's right there. They can handle it, but I think that the consumers are going to use much more so on the smartphone side.
It strikes me that the quicker adopters and the winners in the short term have been the hardware side.
Yes.
Whether it's the chips, whether it's the PCs that can just use what's out there to quickly bring in the capabilities. How long do you think it's going to take before it becomes a software story? We saw Salesforce fall out of bed after not being able to monetize AI. We've seen that consistently. When does this shift to benefit some of the other players?
Yeah, it's a great question. Look, I think the wave of AI really has started sort of first, I think, in the chip-centric world, moved on to sort of physical devices, servers, PCs, right? I think the next leg is really services, because we spoke about machine learning 5 years ago, and what happened to it? No one talks about machine learning. It's all Gen AI today. And no one really adopted machine learning per se in a big way. And there was a lot of help that enterprises needed to even get there. It's the same story. Enterprises are going to need a ton of help to say, well, you go and procure a Blackwell server for $3 million. What are you going to do with it? Right? As an enterprise, you have to have a strategy, a plan. What is the data that's going to run on it? Is the data clean? Is the data good? What is the training software? And what sort of architecture are you going to use? So there are a lot of open questions for which I think the services companies will step in and really help map out that strategy as SI partners or working with the various players in the industry. Beyond that, we think the next leg would be really software. And software, I think, is kind of like, plus and minus. I think when you've got very point solutions of software that are deeply seated in with one vertical, I think a lot of that expertise is where AI puts that at risk. Right, and when you think about that, even in terms of in consulting, even that's been proved to be true. So the more vertical, like smaller sleeves of productivity improvements that can come from small places of let's say like technology knowledge, those are the ones where you can see real disruption. Whereas adopting AI within software is a long-term story where companies that are successfully able to blend that and be much more platform-based are going to be the winners there.
Is the word in telephone catching on?
We certainly hope it will. Look, we thought about this and coined it. It was kind of a fun play on words. But the way we thought about really the concept, right, is... Yeah. And it's appropriate to say this here on Bloomberg, is context is everything, right? And AI phones, that is the difference. It is about the context. You can go back and have a conversation with an AI agent because it already knows the context of your last conversation, right? So if you're replacing a travel agent with your AI agent, you need that context. You want to come back with more information. It's not usually just, hey, book me this and it's done. Give me options. Let me look at that. Let me come back and give you some more information, right? So that back and forth of a conversational agent, we think will be handled by the IntelliPhone.
You're welcome back anytime. Thank you, sir.
Thank you.
Wajid Mohan at Bank of America. Appreciate it. Thank you. The US is leading global oil production for the 6th straight year, according to data from the EIA. Record cash piles by energy giants also fueling consolidation in the space. Exxon, Chevron, ConocoPhillips all announcing new deals this year. I'm pleased to say that with us around the table is Lorenzo Simonelli, the CEO of Baker Hughes. Lorenzo, good morning to you, sir.
Great to be with you.
Massive consolidation, Chevron, Exxon, all the big players in the mix. What does it mean for your world, for services? How are things going to change?
We've seen these times before as consolidations taken place. What it means for us is, obviously, we work with our customers. We get stronger with them as well. And as we see the bigger players get together, we see our opportunities to partner with them on the technology forefront. They're looking for efficiency, productivity. They're looking for ways in which they can also reduce emissions. And as consolidation happens, we actually see it as an opportunity to really grow larger with them from a share perspective and introduce new technologies.
You've talked about this new spending cycle. When you think about new technologies, you're thinking about how to develop existing fields even more or discover new ones.
It's definitely about existing fields. And as you look at mature asset solutions, chemicals, ESPs, electrical submersible pumps, doing more with what we have. We know that today 75% of the production is from mature assets. And we've got to do more with those mature assets. Greenfield costs a lot of money. And so how do you drive efficiencies, productivity with the reservoirs we have today?
There's been a lot of question around, okay, 13 million barrels a day in the United States being produced. Is that the cap? How much higher could it potentially go, and how quickly could it go higher in response to some sort of geopolitical pressure? Given the technology that you're talking about, how quickly could you ramp that up well beyond 13 million barrels a day?
You know, I think we've always been surprised. We've been surprised by the shale revolution. We've always seen technology come in. And I think it's hard to predict how much higher it could go. We've obviously got to recover depletion rates. Technology is going to be the advantage for the producers. How much more? That's a question mark. I think right now our focus is on driving efficiencies and also making sure that we're meeting the demand. And the demand is there. We know that demand is growing globally.
Has there been more of an emphasis in developing some of the mature assets in the fossil fuel industry, and maybe less so on some of the new energies that aren't being rewarded as much by shareholders?
We're seeing both. And, you know, there's definitely a focus across the globe on being able to meet the energy demand, both from a standpoint of the aspect of providing the energy, but also lowering emissions. And so we're seeing both sides grow at the same time. In fact, last year, if we look at our new energy within Baker Hughes, we achieved over $750 million of new orders. This year, we've got a guidance for $800 to $1 billion of new energy orders, and we're set for 2030 to have $6 to $7 billion. So we're seeing the growth there, as well as continuing to see an increase in the aspect of energy demand from the fossil fuels, which requires also lower emissions.
You said the demand is there. A lot of people talking about artificial intelligence and some of the chip centers and the kind of energy that that's going to require. I am curious, as you talk about new technologies to produce more energy, how much of this is going to be through acquisitions versus just sort of organic growth?
Going to be a combination. There's a lot that's being done with regards to incubator technologies around direct air capture, around CCUS, also around the micro turbines and net power when you're looking at clean integrated power solutions. We have a partnership with Net Power, which again is the oxy-combustion process, which allows us to provide 300 megawatts of clean integrated power, which is a great solution. So I think it's going to be a combination of both. I know one thing is for sure. We're going to need a lot of technology, a lot of investment, and it's going to be both inorganic as well as organic development.
There's a lot of consolidation in the industry, but when Baker Hughes comes up, people talk about potentially speculation that you would actually split into two. Is that something you think about as you reorganize the business?
No, we've often looked at it, and we actually have a clear strategy with regards to sustainable energy development and helping our customers. And as we look across our two segments, oilfield services and equipment, industrial energy technology, they really go hand in hand with enabling our customers to being able to improve their efficiency, drive incremental production, and lower emissions. And as we look at increasing energy demand, you need both sides of the house. And I look at a kingdom such as Saudi Arabia, and being in the Middle East last week, they're growing their gas infrastructure. So we're there with regards to our oilfield services, being able to help them with the gas reservoirs. But we're there also with the industrial energy technology, with the master gas system, being able to help them with the development of that pipeline network, being able to help them with the power generation. And so hand in hand, Baker Hughes provides a portfolio that actually provides the full suite.
So better together for now.
Yes.
I know you have a lot to say as well on LNG and the boom we've seen from LNG. What do you make of this administration putting a pause on permits, given the fact that it basically had a promise to Europe that it would be a supplier?
We're disappointed. We're disappointed with the decision. Obviously, the administration has to make its decisions as it does, and we think that global demand for LNG is still strong and robust. We think that by 2030 there needs to be an installed capacity of 800 million tons per annum, and we believe that's going to be coming. And it's either going to be international projects or it's going to be US projects that take place. We're still seeing a lot of activity. You've seen the announcements being made in Qatar. You've seen announcements being made by ADNOC with investments they're making also in Mozambique. So projects are moving forward, and we hope the administration releases the pause and moves forward. There's a lot of natural gas within the United States. There's a lot of good projects, and we think it's an opportunity to be able to, again, provide energy security to the world.
Do you think some of the aspirations to move away from fossil fuels are realistic? What do you say back to some government officials?
I think you need to be pragmatic, and again, you need a sustainable energy development. There is no doubt that you need to move towards energy abundance as well as lower emissions. And you need to do it in a way that is affordable, secure, and sustainable. And so you need to marry a roadmap that introduces an aspect of, let's stop talking about the fuel types, let's focus on emissions, abating, reducing emissions. And I think that's the discussions that we're having, and that's why we're focused on the solutions around CCUS, carbon capture, utilization, storage, direct air capture, geothermal, hydrogen. That's why we're looking at natural gas as being not just a transition, but a destination fuel. LNG, because it's available today. So let's have a pragmatic, sustainable energy development discussion, and let's go towards lower emissions.
Elisa alluded to this. She talked about AI. We talk about NVIDIA every single day. Their stock has had a phenomenal run. The energy demands of some of this are going to be absolutely massive. Have you and the team put some numbers on it? What are the additional energy demands over the next few years going to be from some of these major tech firms?
Oh, they are staggering. I won't give any specific numbers because they can be so vast. But you look at some of the numbers that you get out there, for example, cryptocurrencies. Today, cryptocurrencies use as much energy as the country of Poland. As you look at the AI and generative AI, they're saying 20% increase in US demands for energy just from new data centers. It's going to require a lot of installations of distributed power generation. It's going to require incremental natural gas. It's going to require clean energy. So it's an all of the above strategy. And it's also the use of AI to drive efficiencies as well. So there's the aspect of also us benefiting from the inclusion of AI into the way in which we operate for efficiencies.
How long do you think it's going to take to build out the infrastructure to support the outgrowth of energy demand by AI that so many people are talking about?
You're looking at a number of years, and also it's going to require the right policies and the right permitting to be in place. And in particular in the United States, that's one of the aspects that needs to be resolved, is from a permitting perspective, how do you get that resolved and how do you move forward? Also internationally, as you look at Europe, how do you make sure that the regulations are in place? So that's something that they're working for and they're working through.
Lorenzo, you're in an exciting space, and it's good to catch up with you. Thank you, sir.
Thank you very much.
Thank you. Lorenzo Simonelli there of Baker Hughes. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.